we ventured into the index and ETF space. We thought to ourselves, well, there's a lot of investors who can't do a separate account or can't invest in a private LP, but they deserve to have well-designed vehicles and opportunities to access the asset class. But what we brought was diversified commodities and what's now, it wasn't really a term of art back then, but you think of it like a smart beta or an enhanced beta. We could bring our research edge and Geert's research and his credibility in the space. And so we launched an index, which is the SummerHaven Dynamic Commodity Index.
Welcome to The Derivative by RCM Alternatives. Send it.
Hi, I'm Kurt Nelson. I'm a co-founder and managing partner of SummerHaven Investment Management. We started in 2009 and are focused in commodity futures, which we think are a unique asset class, different from your traditional futures markets in financial assets. It's where we specialize, and happy to speak with Jeff in the podcast today.
What's going on behind you on the wall there? Looks interesting.
So my partner and co-founder is Yale professor Geert Rouwenhorst. So he's Dutch. So he always reminds me that what we think is old in the United States is still pretty new in Europe. But commodities are as old as human civilization, and even commodity futures, interestingly, date back to over 500 years ago in Japan. So we have this history is to remind ourselves and visitors to SummerHaven that there's a rich history to commodities. They may be new in portfolios, but they're certainly not new. Even as commodity futures, Dojima Rice Exchange was started in 1590s or so in Japan, because rice was money to the Japanese economy with the samurai and the feudal lords. And so they actually had not just a spot exchange, but a futures exchange. We have, interestingly, an image from 1830. It's a painting. It's not a photograph because we didn't have cameras then. But the exchange was already a few hundred years old, and it shows people running around the floor. But there's even there's a back office in the corner, and you can see men carefully scribing on paper, doing operations. That was the ops room.
Us Chicago guys don't like to hear that. We think we were first in the commodity. The Board of Trade history files won't like that.
But we do have things going back to obviously the 1800s, because commodities started in Chicago around 1870s. So even there, we've got 150 years of rich history.
So you got your own little museum there. I love it. What's you have a favorite piece?
I think it's the piece from State of Massachusetts Bay, because it's just important to American history. But when the country started and we were in a war with England, we had something called colonial pounds. We didn't have dollars yet. They weren't British pounds, and we were a rough credit, right? We were a startup country at war with our founding owner, and inflation was 100% plus per year in the United States, what was to become the United States at that time. Soldiers would usually sign up for 3 years, and many of the colonies would do a fixed payment system. They guarantee a certain amount of wages if you survived, and 3 years later you could collect from your colony. So Massachusetts came up with something really creative. We think it's the first commodity index. They said, we're going to pay you in pounds, but whatever we'll buy this basket of goods, think of it as CPI at the time, and it was a certain amount of bushels of corn, pounds of shoe leather, pounds of beef, and wool, and roughly, interestingly, we got prices from that time, Jeff. It was roughly equally weighted across those four. Looking at prices and inflation at that time, it actually did a good job of immunizing those soldiers from the costs of inflation while they were sacrificing their lives to try to create our new country. So we have an actual original bond that is used to pay somebody, and it was so fun to see commodities back there when we were starting our country.
But we don't have shoe leather futures anymore, unfortunately.
No, but that's the other thing that's interesting. If you looked at the Dow 30 from the 80s, it would have like Sears and Woolworths and just companies that kids today have no idea. They think, really, that's the dinosaurs, right? That you had people going into into department stores and getting catalogs that were print every Christmas or holiday period to order from. It's the same thing with commodities, but it's just because they aren't relevant today doesn't mean that they weren't commercially really important, 50 or 100 years ago. One example that we found in our historical dive was silk futures. Silk is still, it's not maybe as common, but still used in certain fabrics and in clothes today. It was really big in the first half of the 1900s, and it was largely came from Japan. And it had a very liquid, important futures market that traded, for decades. In 1940 or so, early 41, it stopped trading because FDR could, we were beginning to have tensions with Japan, right? We were halting oil shipments there. It was the precursors to Pearl Harbor. Yeah. And so he stopped the entire silk trade with Japan, which made the futures go away. But it was very
Japanese futures.
What's that?
They were Japanese futures as well?
There was a market in Japan and in the U.S. Yep.
Oh, I love it.
So, there's interesting things over time. So, silk futures today, no, but, we don't trade. We used to trade mess pork because we didn't have refrigerated rail cars yet. And it was they were 50-pound wooden barrels of salted cured pork, but they were deliverable against a future. And
mess pork? Mess that you would serve in the mess hall. Yeah,
I had to look it up, Jeff. And then you had pork bellies, and now it's lean hogs, but it's all pigs, right? So things change over time too.
Now it's the custom cutout thing that they're doing, but it's a separate conversation. Awesome. Well, I'm gonna cut. Where are you guys at? In Connecticut, right?
We're in Stamford, Connecticut. Yep.
All right. Next time I'm out there, I'm gonna come visit the museum.
Please do.
Yeah. So let's go into, how did you get started in this whole world? What's your background?
Sure. I came out of a school with a bachelor's in statistics and math, and I was fortunate that I met a postdoc kind of PhD. I was at William and Mary in Virginia, and at the time I wanted to do business and math, and I was thinking actuary, and this woman. Thank God I met her. She's like, no. You know about derivatives, right? And I said, I have no idea what you just said. And so she gave me John Hull's book. She had been a quant at O'Connor in Chicago, and she turned me on, and I was hooked.
She was a professor there?
She was essentially an adjunct professor finishing up some postdoc research, and those, you meet people in life, right? That kind of can change or influence your course. And she saved me from, calculating mortality tables in Hartford in a closet. And exactly. And I was destined to go to Wall Street. So,
but you still ended up in Connecticut.
That's right. So I did end up in Connecticut. And so I started with AIG trading, great proving ground. And then UBS back pre-merger with Swiss Bank back in the city. I was recruited from there to go to a really great lab for derivatives, which was AIG Financial Products. And, there were a few of those. There was a Credit Suisse Financial Products. Gen Re had one. They were multi-asset, mostly over-the-counter derivative groups. And so for me, it was the best learning environment where I got exposure to rates, FX, equities, commodities.
Well, they were doing commodities as well?
Well, we weren't initially. So what happened is Hank Greenberg and AIG had AIG Trading Group, which had commodities and FX, and then we were more in rates and in equities and more in other financials. And in 2003, 2004, Hank Greenberg said, "I don't want two financial products or financial services companies anymore. You're going to merge financial products in Westport. You guys make a lot more money and are a lot smaller. So I'm going to let you guys drive the combination and just keep what you want and get rid of what you don't, and just make everything one firm and run better," which was quite a mandate, but Hank was that way. And so one of the things we inherited was something called the Dow Jones AIG Index. And it had about $1 billion in it. And it was trying to compete with GSCI. And this is important to kind of the history of SummerHaven too, because we sort of scratched our heads and said, okay, we aren't sure we know enough to say whether we invest in this or shut it down. Let's do some work. And we brought in Geert as a consultant, and he helped to co-author some research to study commodities as an asset class. Like, is this a gimmick or is this something real? And what came out of that was a paper called Facts and Fantasies of Commodity Futures. And it really gave not just AIG, but the street and allocators and consultants a leg to stand on to understand commodities as an asset class. What does that even mean? And so it was the first really rigorous and deep study of diversified commodities futures compared to like things like stocks and bonds, and trying to understand why is there a risk premium? How big is it? How risky is it? And
was AIG's trade group basically, hey, we have all this excess cash from insurance premiums, we need to invest it somewhere?
It actually was, what I understand, it was a team that left Goldman Sachs and said, we can do something better. Like, we helped to build the GSCI, but it was really designed to be a matched book against all the producer hedging we do. So we've got a ton of oil because our book is full of oil. So we're like doing all these hedges with the street, and it's sort of production liquidity weighted. So we're going to sell an index and sit in the middle. And I think there's some truth to that. But it wasn't designed with investors. That's the GSCI. And if you look at it today, 65% petroleum and energy. And so it's got some really huge commodities, and it does have a number, over 20 commodities in it, but some of them are just de minimis, less than 1% weight. So BCOM said that this is it. By the way, Dow Jones AIG today is the Bloomberg Commodity Index. It's it's probably the premier benchmark for indexing performance. So the new index was going to be, we're going to have sector caps and floors, and we're going to have individual commodity caps and floors. So we are going to be liquidity and production oriented, but we're going to do some sensible things for investors to help diversification. And so that was the Dow Jones AIG index that we inherited. There were probably $100 to $200 billion that came into commodities as an asset class from 2004 to 2008, just before the financial crisis.
Was the goal to gather assets, to invest in it, or to invest?
These were directional assets. I think at AIG, our book grew to over 20 billion. But at the time, Goldman was raising assets, J.P. Morgan, Barclays, and it was all swaps, typically structured notes, swaps, coming from a derivatives desk to offer an investor exposure. So you saw pensions coming into the asset class, and they were looking for the first time, I think, investors saw commodities, diversified commodities, as something in the pie chart of asset allocation, right?
Yeah.
Okay, so fast forward to the financial crisis, it suddenly became, not as fun to work for a large financial institution.
Yeah, that's what I was trying to get at. Were they trying to spend this premium money and then they ran out and had an issue?
I mean, like AIG had its own set of issues, right, back then. Yeah. And I had gone to UBS. AIG actually sold its commodity index business to UBS, and I helped to acquire it for UBS. So it briefly became Dow Jones UBS. And then the index business was sold to Bloomberg, and now it's the Bloomberg Commodity Index. It's all the same index over that time. But I just, I wanted to do something entrepreneurial. I wanted to do something with investors, and I didn't want it to be synthetic. I wanted to be a fiduciary. I wanted to be a co-investor and a manager. And so talked to Geert about this, and there was a group of us that had this idea that let's do this as create an investment manager. The market is underserved. In general, there's just not that many independent commodity-focused managers, and we have ideas that really don't belong in a swap or an index, that it really belongs in a fund. And so we started SummerHaven together in 2009, and have just steadily learned and grown the firm over that.
Right after commodities had gotten taken to the woodshed. So were you ever like, oh, are we sure we want to do this? Or did that help the thesis of like, hey, look what we did during that crisis period?
It's funny, Jeff, you knew that old joke about, my mom always said I should have gone to trucking school. And, we had a fork in the road in our careers in 2009. And, in hindsight, probably would have been, a very different experience if I had gone into private equity.
Yeah.
you know,
You and me both, right?
and what we did is that it was really a trial period. It was a proving ground for us because commodities started a 10-year bear market.
Yeah.
The 2010s were not kind to commodities. And yet we survived and we've succeeded. And I think the reason we did that is for a few reasons. One is we were really committed to doing this. We were all in, and people understood that, and they liked that specialty focus. We had good performance in the kinds of strategies that we tried to deliver in. So if we were in a long only mandate, it might be trying to perform relative to a benchmark or relative to our peers. How did we do? So if the asset class went down 10%, but we went down 5%, some allocators viewed that as a big win, right? Because it was their decision to invest. It was our job to manage money in the best way we could. The other thing that I think we learned as a firm is something that it's a free lunch that almost no one takes enough advantage of, which is diversification, right? And so what does that mean for a manager? Well, it means perhaps you do absolute return, but also you do long only or directional. And another way a manager can diversify is that you might focus on the large family offices and institutions, but also think about how do you reach the high net worth or mass affluent. And so
you're saying diversification on your business, not in the business, portfolio.
Exactly. So diversification, the lowercase d, it's just like in general, it's a good idea.
Yeah.
And so what we did is we did grow our institutional business, and that is still alive and well today. At the same time, we ventured into the index and ETF space, and so we thought to ourselves, well, there's a lot of investors who can't do a separate account or can't invest in a private LP, but they deserve to have well-designed vehicles and opportunities to access the asset class. How can we reach those people, those allocators, those investors? So we didn't want to invent this ourselves from scratch. So what we did is we partnered with another firm, USCF Investments, and you may be familiar with them from as innovators in commodity ETFs. They brought out the first oil ETF, USO, first natural gas ETF, UNG, and they've done other things. And it was a two-way street. They had a recognizable platform that investors, were familiar with and had pipes to the street. But what we brought was diversified commodities and what's now, so it wasn't really a term of art back then, but you think of it like a smart beta or an enhanced beta. Yeah. We could bring our research edge and Geert's research and his credibility in the space. And so we launched an index, which is the SummerHaven Dynamic Commodity Index. That's it's got a 15-year track record now. It's done very, very well. It's a long only commodity futures, but with this dynamic,
basically long flat.
It's not long flat. It's always long only. So it's fully invested. But let me describe real briefly what we do, because I think it gives you a lens into how we are different from maybe some others in this space. So we kind of look at 27 markets that are all the large commodities that would be in a Bloomberg Commodity Index or in GSCI. And we rank those on indications that we believe are correlated very much with scarcity and low inventory. And so we cross-sectionally sort those at the end of each month, and we come up with, out of these 27 commodities, 14 that we think are relatively more attractive and 13 that are less. So think we kind of cut it in half, right?
Yeah.
And those 14 that we like get equal weight, and then the 13 get zero. It is sort of long flat in that sense, but we do fully invest. If you put $100 into this index, then $100 would be allocated to these 14. There are some minor kind of guardrails on diversification. Like we do require one petroleum, one grain, one precious, one industrial metal, but otherwise we allow these to float. And it doesn't have this production liquidity constraint that traditional benchmarks have, and that's had really great performance. And it's kind of how we bring our research to bear to try to
create some
increase risk-adjusted returns. And so that approach of being research-driven and then figuring out how to represent that in an effective way in a product or a fund is something that we just do across the board.
Let me back up a hair.
Yeah.
Right. So we had, what was it? Going into 2007, Jim Rogers is on TV in his bow tie saying China commodity super cycle, right?
Yep.
BSCI was huge. So all those assets are flowing into commodities. Institutions were saying, yeah, we need to have 5-10% in long only commodities. Where, like, just take me through that progression from, say, 2000 to the 2010s to today of where you see institutions, whether they have that long only mandate at all, whether it's all shifted to absolute return with commodity exposure. Like, how did you see that evolution?
Yeah, I mean, I think what we saw, as an industry, there was still concerns about what happened during the financial crisis, but that affected all assets. That deleveraging it sucked assets out of fixed income, equities, out of commodities, out of credit. And then it kind of came back with a vengeance, right? Every risky asset rallied hard until kind of mid 2011. I think the expectation of everyone, including Ben Bernanke and Janet Yellen, who I think, was, and Stan Fisher and, these great minds, as well as people in administration on the street, everyone thought inflation's gonna come back with a vengeance too, because we just printed $4 trillion. QE is not fictional. Like, we printed this money. It's got to be inflationary if inflation is a monetary phenomenon. And what did we have? We had disinflation, and we had Draghi in Europe worrying about a deflation trap. Right? We thought, God help us if we get into Japan's trap. So not only was it not inflation, it was disinflation and lower inflation, and commodities represent. They reflected that. Commodities as an asset class probably went down 20-30% during the decade, when equities were going to the moon, and they didn't slow down. So then I think that what we witnessed, and this is across the board, across other managers, peers, there was a general weakening desire to be long only commodities.
Yeah,
there were fewer and fewer investors who wanted to be long. We still managed to find them, and we still had assets, but it was there wasn't as much conviction with some of and we saw consultants start to give up on commodities as an asset class. So I think that trough was in like 2020. And I think that was true. If you look
when oil went negative.
Yep. And we had that crazy moment, like just who'd have thunk it, right? Minus $36, $37 for that short-term print.
But so you think it went like from zero? I mean, before the 2000s, was anyone trying to have commodity exposure?
Yeah, no, I think let's think about commodities as an asset class. So I'm thinking not long short here. I'm thinking long only, right? Because CTAs, as you know, have been active in commodities for decades, right? And so commodities have had a representation even among trend followers. But I would say, there was tens of billions in the early 2000s. I think by the end of by 2010, I think, even with the sell-off and the financial crisis, I think there was still, around a couple $100 billion, maybe $250 billion in directional commodities. So that's across kind of ETFs, private funds, separate accounts. various ways to try to measure that and track that. And I just think that number sort of so you had a 30% decline in performance. So you just had negative performance, which reduced assets. And then some people gave up. So that number probably came down to somewhere between 50 to 100 billion by 2020.
Yeah.
And
my curiosity is whether it went from we need 10%, now we only want 2% or 0, but who knows?
I think
you
for
think
a
of it
lot of
more
investors,
in the billions.
they had 0, and then they went to 3 to 10, and then I think a number of them went back to 0.
Yeah. Or to trend followers or other commodity adjacent stuff, as you're saying.
Yeah, and we would hear messages like, "Well, I'm not sure about the commodity futures risk premium." We were, but some of the investors might be skeptical, or their board might be, and it was just hard to defend. And so they would say, well, I'll do natural resources equities, like timber or farmland or, gas, oil and gas, privates.
Yeah.
Some of them would say, I'll just buy gold, or I'll buy, public equities and resources because it's easier for me to defend.
I want to dig into all those. Yeah. So what do you say, right? If I run the stats, and maybe you're saying this because you're using the wrong index, but if you line up most any commodity index, I think I have used the Dow Jones AIG before, but it's more volatile with lower return than almost anything, than bonds, than stocks, than combos. So I guess that's the argument some of these guys are making. Like, I don't understand the thesis here. What's your argument for no, this is why it still needs to be in a portfolio?
Yeah, for us, it's a data problem. So when you think about Jeremy Siegel or Roger Ibbotson, one of their major contributions was just their empirical studies, like collecting all the stock data back 150, 200 years, and that led to stocks for the long run. So we actually undertook that, project. So the original Facts and Fantasies paper went back to 1959, and it covered 59 to 04. And that was when it was initially published. We actually took it upon ourselves to do a 10-year update in the late teens and to say, okay, there's all of this skepticism about the commodity risk premium, and let's look at the out of sample 10 years. And it turns out there was still a positive risk premium, that it was, orders of magnitudes not dissimilar from the scale and the vol of what was found in the original study. In some ways, that did something to assuage people, but there was still a lot of negative bias against commodities. So, being kind of, nerds about history and really passionate about kind of understanding the history of commodities, we went back and collected all of the commodity futures data to the beginning of time. So we went, through a number of paper sources, newspapers, university libraries, spent, a number of years, and we collected data going back to 1870s. And it's all exchange traded commodity futures. So these were all the major ones that were worth reporting, in the Wall Street Journal or in the, the Boston Globe or the Philadelphia Inquirer.
You probably wish you'd waited a couple of years, and AI could have done all that work in
exactly.
Yeah.
So what that gave us was a time series now that we could compare to stocks and bonds over 150 years. And in fact, we wrote a paper which is available called 1871 to 2018. We've now updated it to 22, commodity risk premium. And the findings there were striking. When you look at on a log scale, the returns to stocks, bonds, and commodities, bonds are at the bottom. They have a lower vol, lower return, but you can definitely see the Bill Gross's career on Wall Street, long-term bonds just going straight up. The whole line took a different slope for the last 40 years as rates, fell after the OPEC inflation. But interestingly, equities have this, volatile but steadily growing upward sloping line to the right, which is the equity risk premium, and it turns out to be sort of a mid-teens vol with an excess return of about 5 to 7%. So you get a Sharpe of 0.4.
Yeah.
On just a vanilla like S&P 500 over 150 years. You look at commodities, it sort of ends up in a similar place after 150 years. It's got a similar return capture and a similar vol. Turns out the Sharpe to commodities is zero point 0.4.
Hmm. Yeah.
It's that's sort of sensational and kind of
I would
against
assume it had much larger vol, but you're saying over that huge period,
no,
similar
it's
vol.
because if
Yeah.
you eat because what's interesting is we've seen that equities have a much higher correlation with each other now than they used to. It used to be that you could diversify U.S. stocks with equities in Europe and in
Yeah.
Japan, and that doesn't work. They're still very correlated. Even emerging markets have become and frontier markets have become correlated. So, but there's still a really low correlation between corn and oil and copper.
Yeah.
And so
Fundamentally. Yeah.
fundamentally, and that still stands true today, Jeff. So you get great diversification benefit by having an equally weighted index over a long period of time. And so there's no optimization to it, but it is rolling front month futures. It captures things like roll yield and contango and backwardation. And so it's an investable time series based on exchanges that were liquid and open for the last 150 years. And so that was fascinating. Just that fact alone,
yeah.
because you think, okay, just to revisit a comment we had earlier on our discussion, a lot of investors have a ton of equity right now. They have public equity, they have private equity, but their commodity futures allocation might be zero. And one of the things we say is, well, it might be something that you have an aversion to. It's a futures market, which might be a little unfamiliar to you. But if you look at the facts, if you look at the returns, the correlations, the volatility, zero can't be the right number.
Right.
Any optimizer will tell you that. So
unless you're optimizing for pure return, maybe, but even then,
but it must be a recency bias or a behavioral bias against them. We respect that, and that's real. The best fix for that is to generate returns for people, so it shakes them out of their complacency. Ironically, COVID did that. Commodity returns are difficult to forecast, right? You can get a long-term average, but if you say what are commodities going to be up next year or the year after, that's tricky. It's as easy in commodities as it is in stocks, right? Which is to say it's not easy. Inflation turns out to not be easy to forecast either. And so we came out, one of the reasons why commodities behave so poorly and why investors weren't that worried about them is inflation was almost zero for, most of the 2010s.
Right.
And the shocks to supply chains and, shifts in supply demands, trends from consumers created some pretty intense shortages during the period right after COVID. And
what do you say to that?
We did not see inflation of 9% coming. No one did.
Yeah.
And you had what I call the immaculate disinflation right after. No one saw that inflation was just going to naturally fall to 3%.
Yeah.
It's like the whole ride was just, it was a shock to our confidence about being able to predict these things. But what we saw was commodities did what they're supposed to do. They just responded really strongly. You saw stocks and bonds go down at the same time, and you saw commodities go up, scream higher across the board. So that was a great reminder to everyone.
Well, it's not. That's an interest, right? It's not that they're rallying because there's inflation. There's inflation because they're rallying, right?
Yes. You're exactly right. And some people say, well, why is there a connection between commodities and inflation? So, well, just think about what inflation is to an economist. It's the consumer price index. And so it's the price of, goods that the consumer's paying for, and it's their prices going up. Well, if you go back one step, then you're in the PPI, you're in the producer price index. So it's the kind of prices of finished goods that producers are, like things like, rolls of copper or, corn that they can use to make cornflakes or wheat for Wheaties. And you go back a step further and you're in the raw good. You're in the actual, bushels
barrel
of corn,
of oil.
Barrel of oil, raw copper ore before it's been refined. And that's commodities. So I almost think like these price shocks I'm not sure exactly the lag, maybe a few months, but first it hits commodities and then it goes to the producer. And then the producer tries not to increase price until he hits a pain threshold, and then he does. And then he passes it on to consumers. And so those makers of finished goods try to not rise prices, but eventually they kind of have to, and they as a group kind of raise prices. And then it shows up in CPI. And so, like,
maybe unless they ignore a few pieces, but
yeah, but there's other things like, healthcare or rent equivalents,
Yeah.
and there's some goofy things in the way we calculate CPI, but there is a direct drive relationship, and that seems to be intact over time.
Real quick, just because you mentioned the timber, right? Family offices, institutions love timber, real estate, all this. So what's your thing of like, you don't need to go, is that too specific? It's not diversified enough? What's your argument for or against that and resource companies of like, why
Sure.
own the copper miner when you can own the copper?
Right. I think what I would say to someone is that there's nothing wrong with owning to own real estate or owning tips or owning commodity equities. Like, that's okay. But understand that commodity futures are different. And so in the commodity equity space, I think that some people that have an aversion to futures, even if there's an easy product that's that they can use, they might say, well, I'm going to buy oil companies instead of buying oil. And so, 10, 15 years ago, you might have bought a huge company like British Petroleum and said, that's oil, ExxonMobil, these are oil companies. And the problem is that for several months or a year, you didn't buy an oil company, you bought an oil spill in the Gulf. And, the price of BP fell 50%. Oil didn't move at all. And so clearly commodity equities, we think, are just that.
Yeah, you buy debt
equities
coverage,
and
you buy
commodities,
management
right?
risk,
Yeah.
yeah.
And in fact, as you probably know, that some big commodity firms hedge their production. It's sort of, they're running a business. So you might sell futures. Farmers do it. Some producers do it. And that's been back and forth debated in the gold mining space. People want it makes sense to hedge the price of gold, but investors want you to have gold beta. Yes.
Actually, we don't want you to be this very profitable company with low volatility. We want you to be a gold proxy.
And in fact, looking back at the 2010s, what you saw was that, commodities fell 30%. Commodities commodity equities went up maybe 50%, and then the stock market broadly went up 300%. So you kind of had you had the negative returns from commodity beta and the positive returns from equities. And so they kind of are 50-50. I just think they're a different animal. I think gold, for example, you can buy gold as a GLD. You can buy it physical. There's different things you can do. In fact, that's been something that's been flying off the shelves at Costco. If you've read that story, they've sold something like $500 million of physical gold. They run out of stock. It's so funny. You get
coins or what?
Yeah, they're coins. Gold and silver. And so
I'm sure there's like a 40% markup on it.
Yeah, you get your 18 rolls of paper towels, and you get 5 pounds of trail mix, and then you get your gold bars and but commodity futures are different, and why are they really exciting to us? Well, number one, they've been around for a long time. Right.
It's usually not what gets people excited. Right?
Well, okay, but they do have this risk premium, which is positive, and it's different in nature than the equity risk premium or credit risk premium. And I think it really is. We've done a lot of work studying this, and they're price risk exchanges where generally a producer, a hedger comes to the market, and Keynes wrote about this, 100 years ago. This is why commodity futures exist and exchanges exist. Is a farmer owns corn and he wants to sell his production, and so he goes to the futures market and he sells forward.
I've argued they should be called nows instead of futures, right? Because that
Yes,
farmer
yes.
wants to lock in a price now.
But you're right. He's
he wants to
demanding.
deliver it in the future, right? But he's demanding a
Yes,
price right now.
he's demanding liquidity, and so
Whenever I try and explain what I do to people and their futures, I don't get it. I'm like, just think about it as nows, and they want to get a price right now. And like, what do they have to give up to get the price right now?
You asked me to kind of, explain like why commodity futures when there's commodity equities or real estate or just what, and so I agree that all of those are options. And why would an investor, if you can own equities or real estate or hedge funds or gold, why would an investor, or what Keynes called a speculator, come to the commodity futures market? Because what's different about a speculator or investor is that you don't have that physical, and you're not running a matched book. You're running a naked long or a naked short, right? So an example: if you go long hog futures to provide a price hedge to someone, and you say, "I want to run a matched book," that you have to cash short sell hogs, and there's no way to do that.
Right.
If you turn that on its head and you say, "Well, if I'm going to short futures,
you can't borrow their hogs, slaughter them.
You can't borrow their hogs and sell them short,
and then redeliver them."
If you flip that on its head, you say, "Well, I can invest cash in hogs and sell futures." It's like, well, kind of, but you're probably buying a farm in Iowa or North Carolina or something, and that's a very different thing. And if it's a mining company or if it's cocoa or corn, like cash carry is really
right. It's right back. You're taking on that idiosyncratic risk.
Yes. So the speculator investor is actually wearing the price risk, and our belief is that that's why there's a risk premium. That to entice,
you have to get paid to do that.
You got to get paid over the long to do it. Another way to say it is, imagine that you're providing flood insurance or hurricane insurance in Florida, and the premium gets driven away by competition so that you can't make money on it anymore. Well, I think the insurance goes away. I think the market
is happening right now. Yeah.
But often what you do is that your people offer it. The ones who remain, they offer it and they get paid a lot. They take a lot of risk and they earn a lot for it. If you're offering flood or hurricane insurance in Minnesota, you might have a market for it, but you're probably taking very little risk and getting very little return. And we think that is a dynamic that exists in commodities. That
the other way to say it, right? It's the producer's not profit motivated. I mean, they are in a weird way, but they're willing to give a discount on their price because they have other needs that they're meeting.
Right, they're managing risk in a different way. And so I did one of the benefits of having been both in the index and public space as well as in the privates as a firm. This was something I didn't know going in, but it was a wonderful kind of added benefit, which is that I can, because these are registered products and I'm managing an index, which is rigorous and public and has returns that are online on Bloomberg, et cetera. I can talk about that. And so I can talk about our index and how it's dynamic and where it won. And our story, I just did a webinar last week for several hundred people. And what we talked about was our public index did really outperformed last year. And two of the big winners were cocoa and coffee. And so they're softs that are overlooked by many, but they're relevant and interesting to us. And the reason why I'm mentioning this is I got a lot personally out of researching these markets for the webinar. Much like the historic wall behind me, I dove into like the history of cocoa in the U.S. The New York Cocoa Exchange was started in 25, so it's having its 100th anniversary now. They were located in a building called the Beaver Building, which it was a Flatiron style building that had the tip, that little point, like the Flatiron Building in Lower Manhattan. It was that tip was on Wall Street, and it's still there. The building's still there, and it's like 2 blocks from the New York Stock Exchange. And the New York Cocoa Exchange was the set prices for cocoa globally, and I think still is really important, right? It's successor exchange that's on ice. But for 50 years, the exchange was there, and the quote in the Times from 1931 from the president of the exchange said it was very important to establish a market for businesses in the cocoa industry that needed a hedge market to protect their business and enterprise. And it was like I extracted that and highlighted it for this webinar because that's exactly what we think, that this is why commodity futures exist. The funny thing that I think tickled me too is that have you seen the John Wick movies? Or you know of them?
I know of them. Yeah.
So there's a hotel called the Continental that all of the assassins hang out in, which is iconic. That's the Beaver Building. That's where the Cocoa Exchange was. They filmed it there. So I just thought, what a rich history. There's like, okay, so cocoa did well last year, and so a bunch of people are noticing it and looking at it. And then I think you have
it's severely underrepresented in most other indices, and even some trend follower portfolios of like, this thing's never done anything. Why is it in the portfolio?
And just a funny anecdote on that. When we used to manage the Dow Jones AIG index, cocoa was one of the 20 or 24 commodities that was in the index, and the oversight committee removed cocoa just because of its smaller scale and liquidity. They removed it from the index about 6 or 8 years ago. It's still something that you can they track and observe, but it's not in the index anymore. And so,
but not to bash the oversight committee, but there's no way if it had been up like it has been the last 4 years, they would have removed it from the index, right? Would you
Correct.
Agree? Yeah. So it's like, oh, the liquidity in this. Well, really?
Getting back to something I said before, predicting the future is hard, and I understand if you're trying to run an index designed to track 200 billion, that you have to make judgment decisions, and you end up with a lot of petroleum, a lot of natural gas, a lot of gold, and even cocoa is not in, but even other smaller things like sugar and cotton. And coffee are in the index, but they're much, much smaller weight. Our view is, you don't know what's, in advance what's going to win, where you're going to have a shortage. And so kind of spread your bets.
And we buried the lead here. We forgot to talk about so you do have a long short strategy also, right? So
yes, sir.
Part of me is thinking, okay, over time, you're like, hey, it's actually better to be long short commodities than just long only or long flat. Was that the logic, or just meet the investors halfway? Some of them want this short side exposure also, right? That's been my personal experience of like buy and hold commodities is very volatile, low sharp. Trend following commodities only is better, but still pretty volatile and not as high of a sharp. Commodities only inside a main trend following portfolio, they look great. But then long short commodities starts to look even better if you're talking compared with just trend following.
I think you're absolutely right, Jeff. And so we have been doing this for the last 3 years, and I think the motive was that it's a different investor sometimes. So an investor that might want long only commodities has their head around the risk premium. They're often looking for an inflation hedge, and so some of our and others investors in long only commodities maybe have a healthy skepticism about whether it really is a 0.4 sharp. Like, is there really a persistent risk premium to capture? But I do know that when inflation spikes, I have strong belief that commodities will go up, and that's why I have it in my portfolio, along with tips in real estate and other things. So that's one reason why you might be in long only. But for those that aren't maybe they're not at that threshold. They're still on the fence. Many investors are looking for uncorrelated return streams, often market neutral or absolute return. That is a very rich environment to try to compete in, and so our thought was that long short commodity futures. It was fairly unusual. The fact that we do not include financial futures, like rates and currencies and equities, kind of separates us from many CTAs that are doing trend following.
And to be clear, it's not trend following. You can get in how the longs and shorts are chosen.
No, it's really more of we take a fundamental approach driven originally from, our research about why these markets work and where compensation to a speculator is higher or lower as a fundamental matter. And that informs our view. So we also have, the benefit of today we have firm AUM about 1.2 billion. We have over a decade of experience at SummerHaven trading in these markets and sort of seeing how they behave, how they work, how our research approach and trading approach seems to apply more or less effectively. And so we've learned from that, and we've said, well, if an example in the long only space, an objective would be to be delivering sort of beta plus. You're trying to deliver some kind of a benchmark that someone might have, and then you're trying to outperform that. And if you can demonstrate a steady outperformance in different markets, different market environments, and driven by different sources of return, and you really have a robust outperformance, it's, I think, a natural extension then to say, okay, how do I take that and convert that into a long short that's not, it's just portable alpha, in a sense. It's it's just an uncorrelated alpha stream. I think that drove it more than anything for us, Jeff, was we have investors who we're not going to reach with long only commodities, at least not today. And so what is it that they are looking for? And they're looking for a diversifier. They're built up on lots of equity, private equity, public equity, tech VC.
Or even you got a guy like me loaded up on trend, all this. I want a little wrinkle out of my commodities of something not price driven, something fundamentally driven.
And so my thought is that one of our goals is to be distinct and differentiated. So it's not that nothing against successful trend followers. I've met some of them and have respect many of them who have been at this for a long time. We're doing something we believe different, and so it sits really interestingly alongside other absolute return streams.
And so talk a little bit, as much as you can share without giving away the secret sauce of how these longs and shorts are identified. Right. So you're kind of trying to see where the shortages are, I'll let you take it.
Yeah, I think what we're trying to do is find markets where there's a risk of a stock out, where there's a potential shortage.
Explain a stock out for my buddy George real quick.
Yeah, absolutely. So stock out would be like, a risk that you're going to run out of something that the global economy needs desperately,
like cocoa.
What was interesting is that with this price run up, there hasn't been a lot of demand destruction. Yeah. So when you start to run out of something, what you find
think is because it's not elastic. You can't substitute whatever.
Correct.
Oranges for chocolate.
Certainly, in the near term, what gives us price, right? Now, what happens is that over longer periods of time, there can be some demand destruction. There can be substitutes. So in the case of a cooking oil, right, you can use canola oil, soybean oil. Canola oil, I mentioned rapeseed in Europe is more of a biodiesel. There's palm oil in Malaysia. But in the short term, like the sunflower shortage driven because of Ukraine and the conflict there just wreaked havoc in Europe. Not as much in the US because we don't depend on it as much. So the short term, you see an amplification of volatility and price action. You also have the ability over a longer period of time to kind of develop new sources, right? So in oil, or in mining, you can develop more mines, more extraction. In Canada, you might kind of bring online some of the tar sands when oil gets high enough in price, but there's a delay, there's a lag. And so you'll see a sharper response at the front end. And I would highlight that, it could be supply driven, but it could also be demand driven. You think about the construction demand and what we saw in lumber post-COVID, it didn't affect all commodities equally, right?
Right.
Eventually these things, high prices eventually solve high prices, low prices eventually solve low prices. And so there's different frequencies to this, but it kind of wax and wane over time. Each commodity has its different cycle. Some of them are seasonal, some of them are not.
But so are you saying you seek out these commodities where you see these patterns versus I have a portfolio and I'm trading each of
we're
these?
seeking commodities where a scarcity led risk premium is greater, and then looking for those others that are in full carry, full storage, ample supplies. If you think about if you're providing price insurance to a market, I'll say an example would be say crude oil during the fracking period. Like we just were getting more and more and more oil in storage. We weren't exporting that much yet. In many cases, we had contracts to import still that we had to honor while we were creating more and more domestically. Storage at Cushing at some point was almost full, right? We've seen this in natural gas too, where during the injection period, sometimes all the salt mines and everything, the caves where we store gas are reaching capacity. If there's during that, once you have that big buffer stock, it could be grains and silos, and you have an increase in demand or a decrease in supply, you get a muted effect, but you aren't that worried because you can just deliver out of inventory.
Yeah.
Right? But when like cocoa right now, where inventories are super low, we haven't had that much demand destruction, and so the only thing to give is price. There's no inventory to pull from in the near term. And I highlight cocoa as a story because this isn't really a high frequency thing. We're not talking about trading on microseconds or nanoseconds or trying to be smarter than the market. This is intrinsically a dynamic in commodity futures markets. In the this movie that we're seeing right now in cocoa, I joked during the webinar that this was a 2020 sequel to a 1970s movie. So cocoa futures are 100 years old in the U.S., and you can actually pull up on Bloomberg the Bloomberg Commodity Cocoa Index, and they have returns going back to the 1960s. The 1960s were really boring for cocoa, nothing really happening. And starting around 71, they had something very similar to what we're experiencing right now. They had a series of poor annual crops.
Yeah.
They had lower and lower harvestable land that was dedicated to cocoa, still subsistence farmers. It wasn't organized or supported by a trade group or by government, coming from West Africa. And they were getting hit with series of disease, weather events, and other things. So that inventories just got very depleted in cocoa. Investable cocoa, if you look at the index from the 71 to 78, went up 8,000%. 80 times. There's a reason why people don't go, long only just cocoa, because you can imagine the volatility of that experience. But if you map what we're experiencing right now in the last 2 years on top of that 7-year time series, we're right on top of it.
Very similar.
We're up 7 times in 2 years, which is basically where cocoa was in 73. And if you read the news stories about the time, kind of a few years into it, the news story said, well, prices are really high, but we really haven't seen demand destruction. Crops are still challenged coming out of West Africa. And there's definitely a thought among speculators, like, is this a bubble that's going to break, or isn't it overdone? And yet we still don't have equilibrium in price, and it keeps going higher. So this was kind of 2-3 years before the peak price in cocoa. And so I don't know if that's going to happen, but it has happened before. And so those are really
interesting. It makes you think this time's different, and this is so unique. It's grown in West Africa, and they have their political issues, and
so things are different. Yeah. Like, for example, we have genetically modified crops, right? We have arable land in the tropical regions that aren't being focused on cocoa, and they could potentially grow that cocoa. Those are all
Mm,
hypotheticals, but it needs to happen, and it takes a few years to get
right.
plants that
Switch
are
over
ready for harvest. So
thousands of acres to cocoa.
yeah, I think we'll wait and see what happens.
Millions.
But we those are all good, important lessons for us, and so we're not really. I think there are some tourists in cocoa.
Huh,
There are some
yeah.
managers who have picked it up and found it interesting to trade. But we've been trading it for 15 years, and we're trading it before SummerHaven, and I think it's important to have that long experience and to be humble that we're not trying to hang our hat on one commodity, but we're trying to trade as many as we can.
Anything else you want me to touch on?
No, I think what I would say is uh, the things that have worked for investors over the last 10 to 15 years, I think are going to be different for the next 10 to 15. I think
No way. Yeah.
2010s were an odd decade, right?
Yeah.
With, as I mentioned, with the QE and inflation went to zero and credit spreads went to zero, and um, I started my career in the mid 90s, so I watched the internet bubble, and I remember that it took, like, for example, the Nasdaq, after it corrected in 2001, it took it,
Yeah.
I think 13 years to get back to break even.
Yeah. It's
Um,
a long time.
I'm not forecasting that that will happen, but I think that this is a different market and it will be a different decade. And so I think it's going to be a very interesting time for commodities. I think that this administration is bringing in a lot of shocks to the marketplace that will affect commodities and other financial assets
And
too, and
in general,
expectations.
you want and like the volatility, like the
We do.
more, right, climate change, administration, political, foreign unrest, whatever.
I
That's
do,
generally going
and
to create an opportunity.
the reason, I think what's interesting is when you think about like a normal distribution of returns, often in, like, for example, equities tends to have a fatter left tail. That Monday morning event is
Yeah.
often an accounting scandal or something negative, and so you'll see a stock just gap down 20%. You can have it go the other way, but more than half the time it's sort of a fat tail to the left. Interestingly, commodities, if you look at the data, it tends to be more on the right side. Those surprises of negative news, hurricane, drought, war, um, supply chain disruptions, tend to be positive for price.
Yeah.
And so, and I think it's positive for vol, sure, but they create opportunities. So we think this is going to be a rich decade, and I think, without forecasting precisely what's going to win, I think there's going to be a rich environment to transact in.
And that will be the hot take award of the year, that the next 10 years won't look anything like the last 10. But as we were talking about before, a lot of people just can't see that, right? What are you talking
Right.
about? Why would you do commodities? Why? I've been seeing more and more of, like, why would you do anything except U.S. equities,
I
right?
think
Like,
recency bias is, it's a big deal. It's just a human condition. It's just something to be aware of. And um, if you left business school, around the financial crisis, say you started in 2010, you've been on Wall Street 15 years. I remember when I had 15 years under my belt, I thought I knew a lot. I'd
yeah,
seen a lot.
yeah,
Um, if you had been on Wall Street from 2010 to 2010 to 25, that's 15 years. You're like, it's all equities, it's all U.S. equities, it's leveraged tech, it's um, yeah, and definitely not commodities. And private is better, illiquidity risk premium. There's all these kind of stories that have worked out for you, but the risk premium to equities over the trailing 15 years is something like, I don't know, 10 to 15% per annum, actually higher than 10, 12 to 14, 15% per annum.
yeah.
We know that that's twice normal.
But
Um,
my counter argument would be, but maybe they've figured it out. The Fed's more transparent. Companies are like, they're tricking us, right? They're making that happen by making sure earnings come in a penny or two exact and all that stuff. Of course, you can do that for only so long, but
I think
right?
that's what it is, and I think uh, I'm not sure that there's a Fed put anymore. With
Yeah.
this administration and with the amount of debt that we have, and the burden of financing that debt, which is non-zero now, right? With interest rates where they are, rolling
Well,
over
no,
debt is not nearly as cheap as it used to be. So I just think it's going to be different. And I understand that if you've been on the street for 15 years, you haven't seen it yet. But try to talk to the guys with gray hair like me who've been around a little bit longer, because I think it'll give you some, a lens, a window into a different
yeah.
market.
And what's your go-to, like how much in commodities? So, okay, yeah, I agree. All this is going to be crazy. Okay, I think there might be inflation. I want to get commodity exposure. Whatever your reasoning, how much?
So,
Which
in
is,
the long short space, it's really it's what you would put into alternatives, and to other hedge funds and CTAs, and I think you compare it on a fair basis against those other kind of absolute return alpha streams. In the directional space, which I think is what you're asking, Jeff, um, I guess I have two answers. I'd say that the street right now, the common wisdom is zero in commodities. We've found exceptions to that, but that's a very commonly held belief, because I don't have anything in commodity futures.
yeah,
If you put the correlations, the variance covariance matrix, the volatility, return expectations, and put it alongside equities and real estate and fixed income and other things, you'd get a number that was surprisingly high. You'd get probably something like order of magnitude 15-20%.
hmm,
Um, I think that that's unrealistic for an investor who's coming off zero.
right,
I think what we find is 5 to 10% in commodities is a sort of comfortable zone for many allocators. Um, and then that gives you the ability, maybe from that base, to tactically overweight or underweight, depending on your views on inflation and the opportunity set. Um, and I think that commodities futures can sit alongside, commodity equities or gold or real estate or other things that you might hold. Um, but I think that what all of our research has shown us is that the right answer in a diversified portfolio can't be zero.
yeah. It seems the right answer is rarely zero. We're gonna end it up with a little fun. Uh, Culinary corner, we call it. So,
Great.
give me your Mount Rushmore, your four favorite around the world in New York City. Where do you want to go? In Connecticut, restaurant spots.
Restaurant spots. Um, well, one of my family favorites. This is hard because it pleases everybody, and I've
Yeah.
got very distinct tastes in my family.
Oh, I love it. Yeah.
And there's
Don't say Olive Garden. Yeah.
but I will say there's a modern Indian place in New Haven
Love
called
it. Yeah.
Sharkeen, Sharkeen. It's right next to the bookstore for Yale, kind of near campus.
Yeah.
But it's like a modern take, not stuffy, but like a modern take on Indian. And if you've had Indian food in most American, it's sort of like Tex-Mex or Chinese American food. It's like the
Yeah. It's
same
kind of,
things, Kung Pao chicken,
yeah.
etc. This is really unique Indian. We go there a few times, several times a year, and we drive. We'll drive. What's really crazy is that we'll drive 40 miles or 40, whatever, to New Haven to have this food, and then we'll kind of come up for some reason to be in New Haven.
Right.
But
So
that's
we
like
got
the
to stop
pizza
there.
mecca of the world. So we could be going to Pepe's or Frank's or Colony Pizza, and we go to get Indian. In New York, along the commodity theme, I think I'd give a shout out to this restaurant called Cote, Cote. I think it's a Korean barbecue. My son
Nice.
found it, and we went there when he graduated from high school last year. It was his the one place he wanted to go,
Yeah.
and I think it's the only Korean barbecue with a Michelin star. But if you want
Cool.
to have extraordinary beef, and done, it's
What's
fun.
the commodity Italian? I missed that.
Beef.
Beef. Okay. Um, where did your son end up going to school?
He's at Babson.
Nice.
And so he, I had to ask him what Babson, like, what do they do?
Yeah.
That's how ignorant I was.
That's what I was about to ask you.
And then my colleague, who's a Yale Business School professor, said, "Oh, Babson's really great." I said, "Well, if you know it and you think that, then I need to respect this choice and investigate." So what Babson is really neat about is they're all about entrepreneurs, and they're not about, there are some people that will go into finance to Wall Street or to, a consulting firm, but many of them are trying to start something from scratch. And that's neat that they take that as an art form. The things that you can learn, whether it's starting a restaurant or a clothing company or any business, like, how do you do it? How do you get capital? What are the things that are so hard? Why do people make it? Some people don't. So
Do you think you can teach that? I'm always dubious whether you can teach. I guess you can, but it's like at some point it's also like I got to think outside the box and think of. But I guess better to have some base to then go think outside the box.
Just speaking from personal experience, I've done two things that I think of like this. So like when we bought an old house, it used to be a carriage barn and literally have like farm animals in it, and then it was restored, but it hadn't been worked on in 50 years. And we bought this thing 7 years ago and historically renovated it and made it bigger. So kind of kept the character of it, but made it modern. And by the time the project was done, I knew everything I needed to know before I started it. And I think, now I'm 15 years into SummerHaven, and it's like, wow, having been all this largely came from Wall Street, right? We hadn't cut our teeth in a small investment manager before. And so I've learned through trial and error what works, and a leadership style that works for me. I wish I would have had 4 years at Babson to prepare me for running a small investment management company. But
and what do you? I've found that the small guys aren't all that different than the big banks. Like once you get down to actually doing the work, and I don't know if you agree or disagree, but maybe they have more expensive Bloomberg subscription terminals, and right, they kind of spend more money. I don't know if they're really.
I think what I would say is whether you're a small company or a big company, in my ecosystem, the main thing is don't take your eye off the ball. Remember why you do what you do. Don't forget about investors. Don't forget about risk and return. Don't forget about taking care of your people. And understand, control what you can control, and understand that there's going to be some things that you can't. Make yourself, as resilient as you can. There's a quote that I enjoy. I heard it from General Petraeus. And I think it was right after he got out of the Army. He may have gone to Carlisle. I think that's where he went. But anyway, he said, luck is when opportunity meets preparation. Exactly. And I was like, I like that. There will be luck, but you need to be ready to take advantage of it. And if it's bad luck, be ready for that too.
Yeah, that exists. Awesome. I think we'll leave it there unless you got one more restaurant burning a hole in your pocket.
No. I really enjoy your podcast and the opportunity to speak with you and your audience, Jeff. I really enjoyed this.
Love it, Kurt. We'll talk to you soon. Saw you in Miami, and now freezing cold. We need to get back there.
All right, let's do that again.
Definitely. All right. Thanks so much. We'll talk to you soon.
You got it. Cheers, Jeff.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts, and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.